My background is I joined the business in 1996. I studied in the US. I went to Carnegie Mellon for my undergrad. And as soon as I finished, I came back and started working in all positions in the company. And then 3 years ago, I finished a program at Harvard Business School, did my OPM, Owner and President Management Program, and have been involved in the business for the last, I guess now, 18 years. Many of you might know about the company. I'll talk about some brief ideas about the company as a whole. I'll also talk about specific macro impact, which I know everyone is very eager to know what's happening with GST, with e-commerce, and impact on the logistics sector. And a little bit run through our divisions so that you get a sense of what we do. The company was started as a one-man, one-office, one-truck in 1958. This presentation, incidentally, is available on our website. And we are a company that currently manages about 7,000 to 8,000 trucks at any given time. We own only about 1,100, 1,200 of those. The rest of them are all outsourced. We manage 10 million square feet of space in India. That's again the largest in the country. But we own probably 1 million to 2 million out of that. We manage, we have a skilled force of about 6,500 people on the payroll, and 20,000 people are outsourced currently, and operate through a branch network of 1,400 locations present in virtually every district in the country, and deep penetration in the major top 40, 50 cities of the country. To give you a sense of that, we have close to probably 100 offices in NCR, maybe 40 to 50 offices in Bombay, and likewise. We are currently moving about 2.5% of India's GDP by value of cargo every year. So we are focused, so we might move 2.5% by value, but not necessarily by volume, because we concentrate a lot on the higher value materials like automobiles or consumer durables or cell phones or whatever, the higher value products rather than commodities like coal or iron ore, etc. I think a lot of this is already given. As an organization, we also focused heavily on foundation activities. We ran the largest program for HIV/AIDS awareness for truck drivers with the Bill and Melinda Gates Foundation. That program finished last year, and we run several such programs even now. The management of the company is essentially split into each division is split into, each division is an SBU which is run by a CEO, and as promoters we are part of an executive committee, and each CEO is part of that executive committee with some of the HODs. Each division is run by itself with their own team of finance, operations, and regional heads. So that's a core committee within each SBU. It's quite decentralized, and to that extent that we are not involved as promoters on a day-to-day level in any of the businesses. The board is quite illustrious in its own way. The chairman of the company, the non-executive chairman, is Mr. S.M. Datta, who was ex-Unilever chairman. And we have several other people like Mr. O.S. Reddy, who was ex-Andhra Bank chairman, and Mr. K.S. Mehta, who is a reputed chartered accountant out of Delhi. Mr. Ashish Bharatram, who's on the board of, who's the MD of SRF, and so on. So the big changes that are coming in from a macro perspective for the logistics sector are several, and fortunately for us, the government is also oriented towards, I would say, logistics, because we've seen a lot of the proposed changes impacting logistics in a big way over time. One of them is GST, And I will talk a little bit more detail about that next slide. The other is any kind of infrastructure development that happens in the country. So the dedicated freight corridor, which is essentially being translated into the diamond quadrilateral, or the increase, the roads that are being built, the expressways that are being built, the ports or the plan for the Sagarmala concept, all of this, any kind of such infrastructure development would have a direct benefit to logistics. One from a capacity perspective, and the other is from the perspective of productivity and efficiency. So today, if the average speed of a truck in India is 23 kilometers per hour, we've done this study with IIM Calcutta, and we found out that an average truck runs between 400 to 600 kilometers a day. If we build more highways, we build the expressways, we think that they should go up, and they should go up, so that will improve productivity and efficiency of a truck. Any kind of infrastructure that we build for the future, because we've been building infrastructure for the past in India, we've always been playing a catch-up game. The moment we start building for the future, we'll see improvement in productivity and efficiency from the operating perspective. Clearly that doesn't augur well for the infrastructure companies, but we have to take a long-term approach on infrastructure. The third point is growth in consumption. Again, disposable income is going up irrespective. So people are going to buy consumer durables, cars, whatever that we speak of. And the way that they will buy, whether they buy it through the brick and mortar channels or through the e-commerce channels, those would be areas of growth. I will talk specifically about e-commerce also in subsequent slides. The other point is increased spend on logistics. What we've seen is that a lot of companies today do outsource their logistics, but they might be outsourcing it to companies on a broader level, or rather not more, they are distributing it amongst hundreds and hundreds of service providers. Case in point, large FMCG in India today outsources its transportation contract to more than 200, 300 transporters, and they run 6 monthly or sometimes 3 monthly contracts. So there's no way that any logistics company can actually invest into that contract. It's essentially you work on a spot basis, you hire the trucks and you service that client. We think that is going to change over time. People are going to look at working with organized players a lot more. We would look at certain industries will change the way that they are handling the logistics. Look at chemical industry. The way that today transportation of chemicals happens in India is very rudimentary. Very few trucks you would see with hazmat standards on them. That will change. Look at how cement is transported. Only a part of cement today moves in bulkers. Maybe a lot more will move in bulkers. It might get packaged closer to the point of consumption rather than at the point of production. So outsourcing has happened, but has it happened in the most productive and efficient way? Is there a scope to do that? Yes. Is there a scope for organized players to grow in this? Yes. The more fundamental point out of all of this is clearly GDP growth. Typically, logistics sector grows at 1.25 times to 1.5 times GDP growth. That's broadly the thumb rule that we have. And so if we are anticipating increase in GDP in the next few years, we will have a direct impact on logistics. So to talk specifically about GST, GST is essentially a consumption tax. Today, the way that states today, a way that a company operates is that because you are getting taxed at a local level, you would have a CNF or a warehouse at every state to avoid that central sales tax, which would mean, for example, take an FMCG company that has 5 production plants and 25 CNF or warehouses of 25,000 square foot each in every state. Now, once that is done, because every state requires you need to save tax on that, so hence you will have a warehouse there. In the future, you might have the same 5 production plants, but you might reduce your warehouses to maybe 12 locations. You bring those warehouses closer together, make it more regional, make it more zonal, because you don't have any tax between the states. Or you pay tax only when you consume that item. So those, if the warehouse is reduced, perhaps the size of each warehouse increases, and perhaps you need, instead of single warehouses of 25,000, you might need a larger warehouse of 75,000 square foot. Now, the direct correlation is that you would need large warehouses, and from a real estate perspective, so you need to build large warehouses. The second is from a service provider's perspective, you need to manage those large warehouses. Do people who are running the 25,000 square foot facility have the capability to scale up to that 75,000 square foot? Because the kind of inventory that you are managing is also doubled or tripled. The kind of throughput that you are handling is also doubled or tripled. Do you have the management bandwidth? Do you have the technology, the IT systems to manage that scale? And many cases you will find that is not going to happen, because the current CNF structure is such that the people at the state level are essentially the local guys, are people who've been with companies for many, many years. So to move to a sort of more organized system, we will see demand for these service providers going up. Clearly, the other impact is on transportation, because if you have consolidated your warehouses into 12 from 25, it means that more volume is going to go to each of these warehouses, and that volume can be multiple aspects of volume. So it could go by road, it could go by a combination of road, rail or sea. So as volume goes up, you would try to seek the lowest possible cost for that as well. So we think demand for multimodal transportation on a hub and spoke model is going to increase further. So this is a sort of a direct impact on of GST on logistics. And as a company, we are quite well positioned to capture this. From the real estate side, we are building some warehouses, and from the service providers perspective, we are amongst the only company in India that manages large warehouses, 50,000 square foot. We can actually do that virtually in a month's time. So that capability at a pan-India level and scale exists with companies like us. And on the transportation side, we have a joint venture with Concor. So I will talk a little bit more about that later. But we can use that capability when we want to offer multimodal transportation. We also have our own shipping business. So on the coast of India, so if we need to move something, let's say a client is moving something from North India all the way to the south, we can move it by rail to Gujarat. We can put it onto a ship and take it by ship to, let's say, a Kerala, and then to put it on a truck and deliver it to a client. This seamless multimodal transportation is something that we're envisioning will be actually a need for the future. The hot topic today is e-commerce, and I guess everyone wants to know what is happening here, and I would think that there's a lot of misunderstanding about what is e-commerce, and also understanding about what is really the areas that are going to be high growth potential in e-commerce. Everyone thinks that e-commerce is that last mile, is that guy coming to your house who's making that delivery. I would like to ask you whether that guy coming in that bike can bring a sofa set on that bike or not. Can he bring a television or not? Those are the things that are going to change, because that delivery person is not going to be able to handle certain kinds of deliveries. Think about another last mile situation where you are a corporation, you are a company that has ordered 20 chairs. Can that delivery boy deliver those 20 chairs? You will need a proper transportation logistics companies to deliver that. So to step back, the whole experience is going to change from a e-commerce perspective to an omni-channel experience. Omni-channel means that you can order from anywhere and you can fulfill from anywhere. So today as a customer, I might want to call up a call center and order something. I might want to use a tablet or a mobile. I might want to visit a store. I might have a catalog. I might have pop-up stores. And these are places where I can actually buy these products. How will they get fulfilled? Either through the stores or through the distribution centers directly, through kiosks, through e-commerce distribution centers. So think about a client who, let's say, wants to order curtains. She goes on the website, she looks at curtains and decides, oh, this is great, but I want to see it physically. So she goes to the store and physically sees the curtains and buys the curtains from the store. Think about a client who does not see it online, just goes directly to the store, sees the product there, buys it there. Another client who probably sees it online, doesn't need to go to the store, orders it online and gets delivered to them. So there are lots of these permutation and combinations that will come up where a client would look at, a customer would look at various channels of fulfilling their needs, and not just one single click the e-retailer and get it delivered. So there will be multiple channels that will coexist in the future. And take that example of the way that companies manage that chain today. What are the various retail channels today? Let's take the example of any consumer durable company. Let's say we take the example of Samsung. Now, Samsung operates through various retail channels. First one is a TOR, or a wholesaler, distributor, traditional retailer. So it could be a Ram Sham Electronics somewhere. This Ram Sham Electronics is selling a Samsung, is selling an LG, is selling a Panasonic, is selling a whatever. So that's one channel. The second channel is an EBO. So an exclusive Samsung outlet. The only Samsung products are sold there. The third channel is an MOR. So like a large retailer like a Chroma, Vijay Sales, or Reliance Digital, etc. That's the third channel. The fourth channel is their own e-portals. So a Samsung might have their own website where they're selling Samsung products. The fifth is institutional or CAM. So it could be a corporation ordering 100 televisions, or it could be the CSD from the army that is ordering directly. So that's institutional and CAM and key account sales. And last but not the least are the e-com retailers. So you could be sending it to the e-com retailer's website, or you could be servicing from this warehouse itself directly to the consumer. So to manage all of these channels today, and they're not going to disappear and suddenly you'll have only the last channel. That's not going to happen so easily. All of these will coexist, and the ability of companies to service all of these channels from a single warehouse is what will actually help the companies have better visibility in terms of inventory and better visibility, better control over their costs. So we as a company manage these warehouses, the CNFs that I talked about for many companies. So at these warehouses, we are actually also doing individual packaging. So a customer might say that, so we might get an order from the consumer durable company stating that please send one television and one DVD player to so and so address. So we will pick that, package it, and use our distribution system to deliver it. So this is one extra element of sort of e-commerce that we will see that will change. So the opportunities in e-commerce are not just that last mile. The opportunities start with supplier coordination. Today, if there is an e-commerce retailer and dealing with 200 suppliers, can they ensure that that supplier coordination is seamless? Do you want 200 delivery vans standing in every evening at that warehouse? Who is going to coordinate that? We know that almost all retailers in this space are struggling. They cannot deal with supplier coordination and management. And that's an opportunity that we think exists, from supplier coordination to inbound delivery management. The second is warehouse management. Once it comes into the warehouse, how about inventory management? Who's going to pick, pack, invoice, do all those value added services? Again, we are seeing that a lot of the e-commerce companies are struggling there. Everyone thinks that they are the Amazon of the world. Again, Amazon also outsources more than 50% of their warehouses globally to service providers like us. It will happen here as well. So it will be a combination model. Today, a lot of the retailers are getting funded. The FDI funding is coming to build those warehouses. But we think at some point in time they'll build that infra, but they'll ask companies like us to manage that infra. So that is already happening. We are doing that with several companies already today. The third is financial management, where you would be asked to even do some kind of payment management, including supplier payments, including maybe at some point in time some inventory holding, that you might want to buy that inventory for a short time. So that's the other opportunities in fulfillment. In the transportation side, you will see requirement from primary and secondary transportations for both first mile and last mile for all dimensions. I talked about sofa sets to small cell phones, high to low volumes. So it could be a single box of a single television to your house to 50 televisions to a company, and at multiple frequencies. So a consumer could be ordering it once in 3 years, but a company could be ordering it once a quarter. So that's the multiple frequencies, and there are companies that might schedule an online ordering system where they might say every 2 weeks, please send me 2 boxes of copy paper, or something like that. Today, the largest sites, global retail sites or B2B sites in the world are actually companies like Alibaba, Amazon Supply, etc., and not necessarily the front end sites that you see. So the B2B element is actually much larger than the B2C part. And essentially these are all the other terminologies about B2B, B2C, C2B. So there are return shipments from customers. So customer doesn't want that, return it back. And then finally the B2B return, which is essentially the unsold shipments that are going back to the vendor also. So all this is part of the e-commerce chain, and not just that one last mile delivery that we hear about. As a company, we are essentially focused into 4 major divisions. The freight business is the older basic transport business. This is extremely fragmented and more of a mature business. This used to be 100% of our business about 12 years ago. It's come down to 36%. And here we compete with almost every transport company in the country. So we are trying to reduce our dependency on this as much as possible. But this business will also move towards that multimodal aspect that I talked about, more towards less than truckload rather than. So we would want to add some value to the customer rather than just do basic A to B transportation. And that's the intent, to sort of change the business model here. It operates at very low EBITDA margins. We do not own any trucks here. We own very little, about 70-100 trucks. Most of the trucks are outsourced. We do not have any other fixed assets here. Only working capital is what is used. And the ROCE at a 5-year level has still been, the last 2-3 years has been a little tight, because we've had successive diesel price hikes. In the last 3 years, the diesel prices have gone up by 50%. That should have technically translated into a 25 to 30% increase in freight rates. That did not happen. So there has been some pressure in the last 2 years, and hence the returns have come down in this division. The second division is XPS. This is a business that is more focused on packages and less on courier. So we transport, we do not compete with the likes of Blue Dart. 85 to 90% of Blue Dart's movement is documents. We do not do any documents. But yes, we do last mile delivery here for clients also, for the e-commerce retailers as well. Our clients here include essentially high value, time sensitive cargo requirements from clients, which include pharmaceutical companies, auto spares, consumer durables, etc. This business has been growing at about 10-12% in the last few years. A little slower because again there was some impact of diesel price hikes where we could not pass on the entire hike, and we were constrained in terms of we did not want to grow at a lower margin structure. So hence we constrained some of the growth here as well. This division has very high ROCEs. Again, we do not own any trucks here. All the trucks are on vendor base, and all the other fixed assets like hub centers and warehouses are actually, for all the divisions, are owned by corporate, and corporate leases out to each of these. So that's in the company, but we charge the rent to each of these divisions. The third division is Supply Chain Solutions division. This is the division that started off essentially. The origin of it is we formed a joint venture with Mitsui and Company about 15 years ago, and there we started with auto logistics for Toyota, and we handle the inbound logistics, that is coordination of parts, picking up parts from all over India, and then bringing it to the production plant and feeding it into the production line. Once the product is ready, we transport the finished cars or two-wheelers or tractors or earth moving equipment to the dealers all over the country, and we also manage spare parts for them, which is the warehousing and distribution of spares. So that's the entire auto supply chain, and we start our learning from the Toyota contract was that we started doing this internally as well, and we now do it for almost all the auto companies in India. About 75% of revenues from this division comes from the auto sector. We also work with FMCG companies, retail companies, consumer durable companies, chemical companies, and the other large business here is the warehouse management that I talked about, the large scale warehousing that we do for clients, CNF management, etc. This division is the only division that owns a lot of trucks. So about 1100 trucks are owned by this division, and they are essentially strategic in nature. So the overall idea, overarching theme for all our businesses is that we do not want to own everything that we need, be it from people to trucks to warehouses. 20 to 25% of our need is owned, mainly strategically, for strategic reasons. Rest of it is all either leased, rented, outsourced. In the next few years, we think that this division will have a high rapid growth also because of the macro factors that I talked about, the increased spend on logistics, the need for warehouse management, and looking at the entire supply chain management for clients. The other bigger division is Seaways. We own currently 5 ships here. 4 are operating on the east coast of India, from Andaman, actually from Vizag, Chennai to Andamans. These are small ships, 4,500 tons each, essentially multi-purpose vessels which moves containers as well as non-containerized cargo. It's very profitable. We do not dependent on any of the international freight rates like Baltic Freight Index, etc., because all our earnings are in rupees. The 5th ship is a service that we are going to start from by the end of this year from the west coast of India. This will be a container ship moving from Gujarat to Kerala. The growth of this division essentially comes from the growth of any new ships that we add to the system. I would not actually spend time on each of these divisions specifically, but the presentation is available on our website. So just to talk a little bit on the joint venture with Concord, the idea was to actually provide a seamless solution to clients. Clients, when they dealt with Concord, were getting only the container service by rail. Many times the need was, can we provide you a door-to-door solution? So the first mile and the last mile is handled through TCI, and the container movement by rail is handled through Concord. The customer gets a seamless experience. The contract is held by the customer by this joint venture, and the joint venture then outsources it to TCI or Concord. When we go to clients, we've been selling them a concept where we are saying that don't look at your transportation on a yearly basis. Look at your transportation on a longer term basis. Look at your transportation not from that fragmented, giving it to any transporter that is there locally, but think about giving it at a longer term, I would say a bigger contract. Don't worry about the pricing. Give us your target pricing. Give us your transit time. The mode is up to us. We will take it by road, rail or sea, but we will get there on time at your price target. And that has started to work with clients, and the business grew from 25 crores the previous year to 50 odd crores last year, and we are seeing good growth this year also. There are challenges here because when we go to clients, it's difficult for them to shift to this movement, but we are trying to sell that concept to them so that we can provide a seamless multimodal solution. Again, with all the impact that we talked about in GST and other areas, we will see that will also play an important role on the multimodal side. These are some of the financials. Again, these are all available online. As you can see, the share of the freight business has come down from 52% in 2009 to 36% as of the first half of this year. XPS I already talked about. We are projecting to grow at about 10 to 15% again going forward. Supply chain business, apart from the 1100 trucks that we own on the customized fleet side, we also own about 38 trucks on the cold chain side, which is essentially moving pharmaceuticals and less of the food products, because we see a lot of value in pharmas and not so much on the food where the pricing is very tight. The cold chain sector, our understanding has been over-invested currently. In the last few years, there has been a lot of capacity that's come in, private equity money, etc., into capacity creation on both the transportation and storage side. So it's a business that we have limited exposure to, and going forward, our intention is to create some warehouses or some locations where we can service clients with both the dry movement as well as the cold movement together. So it will be more like an integrated solution for clients. I also talked about the joint venture company. This is a company that's in the last 15 years we've grown to about in the excess of 300 crores in revenue. In the last half, the first half of this year, we've grown, supply chain division has grown by about 24% on the top line. And we think that we should grow at about 20+% in this financial year. I already talked about the Seaways division. Global division, we have essentially operate local logistics in some countries, South America, in Indonesia and in Nigeria. In Nigeria, we have a joint venture, and in Indonesia also we have a joint venture. But it's essentially local logistics, and currently this is a very, very small part of our overall business. We have a small energy division which was invested several years ago for tax reasons, and we have about 11.5 megawatts of wind power. We are looking to put up some solar solutions on warehouses, and we've experimented at one location, and we are seeing how beneficial it would be from an energy efficiency perspective. So it's a very small investment there. About 4 years ago, we also demerged part of some real estate from this company. Currently, the company has more than 300 properties on our books, and about 13, 14 of them were demerged in 4 years ago into a separate listed entity. and that is essentially to monetize those properties for commercial or residential needs. This is a split of the revenue contribution and the profitability contribution. Clearly the freight business though contributes the highest in terms of revenues, but profitability is amongst the lowest. Again, this is a factor of what happened in the last 2 years, and we definitely think that this is going to improve going forward. So last financial year at a standalone basis, the company did about 2,000 odd crores of revenues and about 62 crores of PAT. I think going forward, we would look at a 10 to 15% increase in top line and a similar increase in bottom line. In the last few years, one of the reasons that we've seen, we've not overly expanded. We've also been cautious on maintaining our margins, so which meant sacrificing certain amount of growth. It also meant that in the tough times, the last 2-3 years, we emerged stronger. Debt profile is quite stable. The 350 odd crores of debt that we have, almost 70%, 2/3 of that is working capital. Our current debt equity ratio is about 0.74. We have the top rating from both CRISIL and ICRA, and our average cost of borrowing today is under 10%. In terms of capex, if you see the first two columns, in the last 7 years we've invested close to 600 crores, and we've had one fundraise of about 50 crores in 2008, and so most of it has been internally funded and with some debt. Essentially most of this has gone into building small hub centers and small warehouses, and also into trucks. Going forward, we have a plan of spending about, that's the last column, about 275 crores this year. We think we'll do probably about 175 crores this year, because some of the areas where we are trying to invest into building properties or buying properties has been delayed, and because of clearances, etc. But our 3-year plan is to look at about 500 crores of capex, roughly one third in the next 3 years. Part of this funding will happen through internal accruals, debt, and we are looking for a small fundraise of about $10 million in this year. We have a consistent dividend track record, and the payout has been under 20% for the last 6 years, and the promoters currently own about 69% of the shares. To sum up, the drivers of the business are going to come from express and supply chain in the next few years. Clearly, whatever happens on the macro front, some things will happen and for the positive, and that will have a direct impact on our business and an indirect impact on certain areas. The only challenge that I see is how fast can we scale up. The availability of manpower, the availability of creating infrastructure at the speed and at the right timing has always been, is a challenge even today, and that is something that we feel would be a constraint. Other than that, we do not think we should see a next 3 years of at least 15% CAGR top line and bottom line growth. Thank you.